As a professional investor, the big learning came in 2000. We had invested in the same, stocks. And one of the investor came back to me saying that, Nilesh bhai, if I want to make this error, I am capable of doing on my own. When I give you money, I expect you to make errors which I won't make myself.
Yeah. Oh.
Hello, listeners. My name is Raj Singhal, and welcome to another episode of Breaking Investment Stereotypes. Here we deconstruct world-class investors or wealth managers and deep dive into their investing journey, professionally, personally, or both. This episode is brought to you by Multipie.co, where we believe that investing is an ignored life skill. Our mission is to create a platform where people can come, learn, share, and collaborate through the right tools. We have some important updates for you all. We are now rolling out invites to people who are on a wait list. So do check out, and if you're not yet subscribed to our wait list, please do so at multipie.co and we will send those invites to you as well. I want to give little guidance to how to use the shows. None of the following should be taken as investment advice. Please see multipie.co/disclosure for more information. My guest for today is Nilesh Shah, someone I admire a lot and whom I have the pleasure of knowing for last 25 years. Nilesh Shah, or Nilesh Bhai, as is popularly known as, is Group President and Managing Director of Kotak Mahindra Asset Management Company Limited. Nilesh Bhai was part of the team that has received the Best Fund House of the Year award at all the mutual funds where he worked, namely Kotak Mutual Fund, ICICI Prudential, and Franklin Templeton over the last 3 decades. Nilesh Bhai is chairman of AMFI. He is a member of Mutual Fund Advisory Committee and a part-time member of the Economic Advisory Council to the Prime Minister. Nilesh Bhai was featured in top 50 people of India by India Today for CY20. So without further ado, please welcome Nilesh Shah.
Hello, Nilesh bhai. Welcome to the show. Very excited to have you here.
Thank you, Raj, for inviting me. It's a pleasure to be here.
Well, thanks a lot. No, I'll start with your personal life first. And I know that you started working very early in your life. Did an articleship, met one Guju sub-broker who actually gave very important lessons in trading, and went on to achieve gold medal in CA exams. So want to hear more about your initial journey into the markets.
So I grew up in a chawl system in Mumbai. It was one big happy Indian family, more than 200 family. Unfortunately, I lost my dad very early in life, and I, at one point of time, thought that it's better to start working rather than studying. And I'm thankful to my school's principal, Jani sir, who said that, no, you must study and I will bear your education expenses as long as you top the class. And thanks to his support, I continued my study. At that age, it was important to earn money, but thanks to Jani sir's encouragement, I remained focused on study, and probably that is why I have reached where I am today. I moved to study chartered accountancy course because that was the most cost-effective course available. You could earn money while pursuing that professional course, and my office was next to Dalal Street. I could hear all that noise. In our building, we had stockbroker's office. So started dabbling in stock market, made some money during Harshad Mehta time and lost everything by the time it ended. And that's where I started going to people who understood the movement of market, who understood the ups and downs of the market. And that's where I wrote that article about the Dagladhari uncle who was giving us good guidance on stock market. And one thing which he taught me has remained always with me, that in stock market, we do Lakshmi Pujan once in a year, but we have to do Saraswati Pujan every day to earn money. And that's the power of knowledge. That's the power of wisdom. So over a period of time, I made a lot of mistakes, but ensured that I don't repeat those mistakes. And, that has taken me here.
That's very inspiring journey, I would say. And I we've go back many decades, and I know that you started your career actually on the fixed income side, which is where I spent all my life, and then of course you're running the whole AMC now. But what's your you've done fixed income, you did of course equities, now running the whole show. Uh, Tell us where is your love? I mean, in terms of fixed income and equities.
So obviously, when I started my career, I was sent to JP Morgan, Singapore for learning FX. When I came back to India, I realized that the opportunities in fixed income and not in FX. Moved into fixed income. Was fortunate to work with ICICI Securities, and it was one of the most brilliant team around. Grew with them, moved to Templeton, and for years delivered fixed income fund return, which was better than many equity funds. So fixed income remains first love. It gives you very good understanding of macroeconomy. It gives you very good understanding of credit. But in 2003, I realized that the golden period of fixed income is coming to an end. And now interest rate rise, it will be very difficult to make money. That's where I decided to move into equity, and the articleship days came to help. Had made a lot of errors in those days, so I could start ensuring that I don't repeat those errors. I was lucky that I got a break in ICICI Prudential Mutual Fund, managed equity, debt, overall investments for a while, and then I briefly went to sell side in Axis Capital. I realized that it's not my cup of tea. And, there was one incident which actually prompted me back to mutual fund. I had gone to attend a distributors conclave in Grand Hyatt, Santa Cruz. And when I was walking from staircase to the main stage, so many mutual fund distributors came and met me. Some people had brought sweets, some people had brought khari singh, some people had brought naan khatai. And by the time I reached my stage, all my hands were full with bags and packets. And then I realized that this is where I have love of people. This is where people remember me. What am I doing on sell side? And that's where I decided to move back to mutual fund. Fortunately, Kotak gave me an opportunity as CEO. And this is one field where Rajbhai, I say, कि आपको पैसा भी मिलता है और दुआएं भी मिलती है. I am very well paid by my company, and more importantly, I accumulate blessings if I do my job well. What could be better than this, where you are paid as well as blessed together?
Awesome. And you're talking about your distributors coming out with those whatever snacks or sweets and all. They knew how to get a Guchu Bhai back into the game, right? By the way, yes, I just realized that 2003, what an awesome timing to actually switch from fixed income to equities, because fixed income were at the highs and the equities were at the lows.
Absolutely. So I started searching for switch in 2003. I was lucky in May 2004, where I got an opportunity.
Awesome. So, let's come to the market, and, big question on everyone's mind is where the markets are headed, right? I mean, globally markets are looking very overstretched. People are chasing growth stocks at any price. We have DMarts at 200p, Pidilite at 100p. And now a lot of people call it a liquidity driven rally as well. And I know it's not easy to predict market, but just want to pick your brain in terms of where you think we are headed. And more importantly, are we headed into what happened in US in 60s and 70s? Now it's a very long time back when, Nifty 50 grew up parabolically and then came crashing down when gold standards were broken. So just want to hear your thoughts.
So my feeling is that today we have Triveni Sangam of sentiments, flows and fundamentals in our equity market. So it is not a bubble. Does that mean there will be no correction? No. As we speak, last 3 days markets have corrected. But will there be a crash? I'll be highly surprised if that happens. I don't think so. March 20 is going to get repeated in near term, unless until something changes fundamentally. Today, sentiments are bright and optimistic because economy is opening up. activity levels have already reached pre-pandemic level. Now, unless until there is a reversal due to a third wave, I don't think so sentiments are going to get reversed. From a flow point of view, domestic institutional investors led by mutual funds, insurance companies, pension funds, they are all buyers of equity. Foreign portfolio investors, thanks to what's happening in China, as well as what's happening in India, is a net buyer. In FY21, they brought more than 26% of all the money they have brought into India over the last 3 decades. And most importantly, retail and HNI investors are also net buyers in market. Except promoters who are selling, virtually every other investor segment is a buyer in the market. Now, we all know sentiments and money flow can lift the market for a while, but not permanently. And this is where fundamentals are extremely important. Now, if you look at NSE 500 companies' profitability, it was about 32,000 crore in June 20 quarter, which was impacted by lockdown. In June 21, about a year later, it's almost 2 lakh crore. So there is a 6 times jump in profitability. From a valuation point of view, market looks little bit on the higher side at 20 times FY 2023, but it doesn't look exorbitant. The bubble used to happen at 40 PE for market, 60 PE for market, but at 20 times it looks little over fair value, but not significantly over fair value. So corrections will come in the market undoubtedly, but a big crash is unlikely to come unless until sentiments, flow, or fundamentals gets reversed.
Okay, no, yeah, that's very true. And coming to the small cap and mid cap, you mentioned, we are already seeing some bit of a correction. Again, picking on one of your learnings, I think you mentioned when Batata trades at a premium or Tata, it is time to get out of the market. Where are we on that?
So there are 2 pockets in market where I believe there is a bubble. This bubble is from a price point of view in one of the red zone. So there are some very good businesses where floating stock is very, very limited.
Yeah.
And more importantly, that floating stock is controlled by some investors. Now, this is creating a situation where any price can be printed. There's nothing wrong in the businesses, but the valuations have become excessive. And if you invest in that zone, you'll have to compromise your future return. Prices could correct if there is increase in floating stock, or prices could stagnate because after a while, the existing holders will start distribution. The second red zone is where business and valuation both are wrong. For example, there are some SME IPOs which got listed. Now, here we believe a lot of them are way ahead of their business as well as valuation fundamentals. There are certain stocks which are peddled by social media influencers. You hear them in Telegram channels, you hear them in WhatsApp, you hear them in YouTube videos. Now, this social media peddle stocks neither have businesses in most cases, nor have valuation justification in most cases. So unlike first, where you may compromise on your future return, here you will definitely compromise on your capital itself. Now, these are the 2 segments in markets which are avoidable. Please avoid high valuation, but concentrated holding stocks. Please avoid stocks where neither business nor valuations are justifiable.
No, that's very rightly put, and we see that, right? And we have seen some of them actually coming crashing by in the last couple of days. Some of those low float, and a lot of people actually calling jokingly, I'm sure, low float as a moat, right? That's the moat of the stock. It's a low float. Now coming to
it is a moat for existing investor,
yes,
not for you, the new
yes,
investor.
I agree, completely agree. Coming to the 2003 to 2008 phase, right, when actually we saw a drastic rally in the market at that time, and that's when you also began your career in the equity markets as well. A lot of people are comparing current market with that. More importantly, in terms of the Capex cycle, because that was a phase when Capex cycle was taking off. And there is a lot of talk around, about the revival. What is your reading on the ground situation? Public and private Capex. I mean, there are a lot of data which says that the Capex as a percentage of corporate expenses is as all-time low. So, help us understand more about this whole Capex cycle.
So, Rajbhai, if we see since independence, every of our peer has outperformed us. In 60s, we were similar to Korea in per capita GDP. Today, they are 12 times bigger than us.
Yeah.
In 80s, we were similar to China. Today, they are 5 times, 6 times bigger than us in per capita GDP. So we must have done something wrong to restrict India's growth. And this is best illustrated by one Singaporean minister who said that if you compare Indians earning per capita income in US, they are roughly at about $55,000. Now, if Indians in India were as good as Indians in America, we should have $75 trillion GDP.
True.
We are at 3 trillion. That's the potential gap. Now, one can legitimately argue that, look, the cream of Indians have gone to America, and hence it will be unfair to compare Indians in America to Indians in India. Fair enough. Let's put 75% discount to it. That Indians in America are 3 times better than Indians in India. With that also, we will come to a GDP number which should be bigger than China. So clearly, we have followed certain policies over the last 7 decades which have restricted Indians. And now those policies are getting changed for better. So Rajbhai, if you see the 50s, 60s, 70s movie, the villain was always a food smuggler, black marketeer.
Yeah.
Now there is terrorist. Because inflation has ceased to be an issue. And today when people are talking about high inflation, it is mid-single digit. Earlier when people were talking about inflation, it was double digit. So India is transiting from high inflation to moderate inflation thanks to inflation targeting framework of RBI. In the 90s, Rajbhai, FX reserves were so poor that we had to pledge gold to borrow money. Now we are sitting on 4th largest FX reserves. In second wave of COVID, when we had to import oxygen tank, oxygen concentrator, medicine, we were able to cut the check because we had money.
Yep.
This transition from low FX reserves to high FX reserves is a great platform. Earlier, we had infrastructure deficit. Mumbai to Pune was an overnight journey. Thanks to Mumbai-Pune Expressway, it became a 2-hour journey if you came out of Mumbai traffic. Infrastructure is available. Today, people are talking about coal shortages, but those guys have not witnessed power cuts which we have witnessed.
Yep.
The infrastructure deficit to infrastructure availability is a great platform. Earlier, our infrastructure was physical. Now it is digital as well as physical. Earlier, to get a checkbook from a bank, you had to go to the bank. Today, you are ordering it on your app. I mean, look at the COVID program. We have administered 100 crore doses and provided, digital certificate. The entire process is so smooth that it's been an amazing journey. This infrastructure from physical to physical and digital again gives a great platform. We have also replaced crony capitalism to transparency. Earlier, you had to take a shortcut to get an iron ore mine, a telecom spectrum license, a coal mine, and so on and so forth. Today, thanks to the government and courts, it's a transparent, open process. And the biggest change which India is seeing is transition where government has accepted that we should be running business to government has no business to be in business. Air India, when it was run by Tatas, it was a small airline, but a niche airline. People took pride in traveling with Maharaja. Over a period of time, Air India became an airline where number of employees per plane are more than number of passengers per plane. and government had to contribute more than 100,000 crore to support that airline. Air India could have become Emirates, Etihad, Singapore Airlines, but it didn't become because it was run by government. Now it is divested. Can Tatas restore the glory of Air India? Well, it will be a tough job, but they are capable of doing it. Yep. This transition from commanding heights to PSUs to public-private partnership is the most important thing which has changed in India. And finally, Rajbhai, आप और मैं अगर धंधा करना चाहते तो बाप के पास से पैसा लेना पड़ता था. और अगर पिताजी के पास पैसा नहीं हो तो आप कितने भी ब्रिलियंट हो, you had no option but to do a job. Yeah. Now that Lalaji culture, that Sethji culture is getting changed with idea, with entrepreneurship. If you have an idea, there are venture capitalists, private equity who are willing to back you. This availability of capital for backing an idea which was not existent in our young days is available to today's youth. Now put all these things together: moderate inflation, high FX reserves, infrastructure availability, digital infrastructure, meritocracy and transparency, government doing public-private partnership, and capital being available to good entrepreneurs. Will this not create better growth for India in the days to come compared to last 7 decades? Answer is undoubtedly yes. Now there will be many manifestations of this growth. There will be many themes which will run on this platform. But this is the platform which will propel India to 5 trillion and eventually to $10 trillion and eventually to the second largest economy in the world behind China.
No, that's a good segue. Can we talk about, as we've spoken the platform where we are right now, what are the 2-3 trends you see playing over in the next 10 years? I mean, no one has the crystal gazing ball, but where do you see India in 2030? I mean, we talked about 5 trillion, 10 trillion. I mean, of course, all that's going to happen, but in terms of trends.
So one trend where India will do very well is becoming part of global supply chain management.
Yep.
China became manufacturer to the world. We became generic pharmacy to the world and back office to the world. But we missed this manufacturing game. Today, manufacturing contributes just about less than 1/3 of India's GDP. Within that, 1/3 comes from just automobile sector. Our manufacturing exports are fairly low. Yeah. And we are not part of global supply chain management. Now we are becoming part of global supply chain management thanks to production-linked incentive scheme. We were large importer of mobile handsets as we were the second largest mobile handset consuming market. Our annual bill was running as $8 to $10 billion a couple of years back. Then we invited mobile handsets manufacturing companies to India. They started assembling mobile handsets over here. Value add was about 10-15%. Now, as the scale went up, they invited their vendors to come to India. Now, value add is moving from 10-15% to 20-25% and eventually will become 35-40% over next couple of years. We are not making chips, which is heart of mobile phone, but all other parts are being made in India. And we have now become net exporter in mobile phones. We have overtaken Vietnam, South Korea in manufacturing mobile phones. In fact, we are the second largest mobile handset manufacturer just after China. The world's largest mobile handset plant is now operating in Noida by Samsung. Now, PLI scheme is there in API, bulk drugs, textiles, auto component, electricals, electronics, toys, and many other industry. PLI scheme will create manufacturing base for India. We won't become manufacturer to the world like China in next 10 years, but we will certainly close the gap with China in becoming manufacturer to the world. The PLI scheme linked global supply chain management participation is as big a story as technology was in 2000 or generic pharmacy was there around the same time. The second thing which is going to work for India is revival of industrials and Capex. For last 5-6 years, private sector was working on the back foot. There were not much capacity addition. there was not much capital goods order. Now we have seen revival. Steel companies are announcing expansion. Cement companies are announcing expansion. Sugar companies are announcing setting up of ethanol blending. The government has fiscal space to spend money, and they are building infrastructure at a rapid pace. The export market is looking good, and many of the multinational companies will outsource their export commitments from their Indian subsidiary. Put all these things together, could we see a period like 2003, 2008, where industrial capex led by private sector starts delivering and kind of pushes growth, which is today driven just by consumption and government spending? We believe on the industrial side, capital goods side, there is a very good chance of revival for next couple of decades to come. The third and the probably biggest of opportunity is digitization. In global markets, many Western markets, digital properties are owned by private entrepreneurs, and that creates monopoly or oligopoly. For example, in card payment, Visa and MasterCard virtually have oligopoly. Now we have created digital infrastructure through Aadhaar, Bheem, RuPay, account aggregator, data lake, and so on and so forth. There's no monopoly over there. It's available for any investor, any entrepreneur. And this digitization of India will create many unicorns. And this model will now expand from India to outside of India. Our CoWIN can be copied in any other country. Our Bheem UPI can be copied in any other country. Our Aadhaar can be copied in any other country. Now, this digitization is one of the biggest opportunity. Like Indian IT companies went and conquered services sector, I think time has come for Indian companies to go and conquer product services, especially in public utility. So digitization, capital goods, and PLI related participation in global supply chain management, these are the three themes which I believe will move India's growth rate from mid-single digit to probably double digit.
Okay, that's pretty bullish for the country. You're part of the PM Economic Advisory Council, and we are seeing a lot of actions from the government side. PSUs are back in discussion. You spoke about privatization of Air India, and also there is a push for reform in power sector, infra, Gati Shakti, which PM just announced, asset monetization. Can you tell us more what government is trying to do to revive this economic growth? And you just mentioned that, right? We are heading towards double-digit growth. What can government do to help that?
So the government is essentially, from an economic growth point of view, focused on expanding the pie rather than allocating the small pie. That is the big mindset change. Earlier, we wanted to reduce inequality by making everyone poor. Now, we are saying that let people become rich, and then we'll figure out how to allocate that pie. This is the biggest mindset change. And governments have taken numerous steps to support entrepreneurs. Our biggest challenge was related to rule of law, land acquisition, labor laws, availability of capital. They were all challenge for entrepreneurs. Our entrepreneur was like an Abhimanyu, and unlike Abhimanyu who decided to go on his own volition to Chakravyuh, our entrepreneurs are born in Chakravyuh. And Abhimanyu was at least fighting Kauravs, which is market, price volatility, infrastructure bottlenecks. But the modern Abhimanyu entrepreneur is also fighting Pandavs, which is the tax burden, tax compliance, rule of law, and so on and so forth. Now, in Mahabharata, Abhimanyu could not defeat Kaurav. In modern Yug, how will Abhimanyu defeat Pandav and Kaurav together? Yeah. The government is now supporting Abhimanyu. They have simplified laws. They have improved ease of doing business. They are ensuring Startup India to provide capital to businessmen. They have pushed meritocracy in bank lending. They have taken away external influence on lending system. They are building infrastructure at a rapid pace. essentially they are doing everything possible so that entrepreneurs are supported. And more importantly, politically, India is being recognized as, one of the biggest alternative to China. Recently, John Chambers, ex-chairman of Cisco, mentioned that if there is one country in Asia which I have to bet, I will bet on India twice. Tony Abbott, ex-Australian Prime Minister, narrated this in a different way, where he said India is alternate to China in every other way. They are not as rich as China today, but it's only a country which is under rule of law and democracy and capable of having the same potential as China. So government has created that brand image for India. They are supporting entrepreneurs. It's an ongoing journey. We have a long distance to cover. But by simplifying rule, by ensuring capital is available, and by giving global branding power, I think now our entrepreneurs are equipped to handle market volatility.
Awesome. Let's come to one of the sector, automobile, and it's been an underperformer for the last decade. I think the vehicle sales are probably the same as what it was in 2011-12. Now there are supply side issues, but there is a big push towards the EV. Now, do you think this is the turning point for the sector, or you think the profit cycle will still take some time to kick in?
So in the automobile sector, Rajbhai, there is a double horse running around. I think everyone is clear that fossil fuel needs to be ended thanks to the global warming. But will the journey be straight to electric vehicle, or will it be to fuel cell technology, especially hydrogen, or will it be hybrid? My guess is that as India, we should keep our options open.
Yep.
We should encourage electric vehicle. We should experiment with fuel cell technology vehicle, and we should also push hybrid vehicles. This combination will ensure that no matter what succeeds, we will be able to then ride on that. Now, if you look at automobile sector, we were the first Asian country to manufacture automobile. Hindustan Motor in West Bengal, Uttarpada, created first automobile factory. Unfortunately, the same models continued till 1980. In 1980, Suzuki came to India. They brought modern automobile, fuel efficient, convenient. They kept on launching newer and newer models which are suitable for India. They expanded their distribution network. They brought their vendors so that quality was maintained. And slowly and steadily, automobile sector started taking off. Today, it's one of the few manufacturing items where India has a trade surplus. 1/3 of India's manufacturing GDP is contributed by automobile sector. It has created jobs, it has created export surplus, it has created growth. Now, on this, we have to build. And we should build from fossil fuel to electric, fuel cell, and hybrid. We should ensure that we not only capture domestic market, but we also capture global market. And we continue to expand our automobile sector, not only in four-wheelers, but also in two-wheelers and commercial vehicles and tractors, and so on and so forth. Overall, we remain bullish on automobile sector. However, is this the time to invest in automobile sector? Answer is no. This is the time to accumulate in automobile sector. Currently, automobile sector is going through twin pressure. One, raw material shortages, and second, higher raw material price impacting margin. So unless until we see a volume expansion, there is no point in investing in automobile sector at current valuation.
Okay. Now, markets are very bullish. The India story looks very bullish. You just mentioned a couple of points on that. But we see that, gold imports are again picking up multi-fold, right? I think it went up 3-folds. Why are people moving to safe haven?
So gold is a social obligation to Indians. My mother pushed me to buy gold because I have 2 daughters, and she said, what will you give them, at the time of marriage? Now, this is the one reason why people are buying gold. The second reason, and this was told to me by someone, that many poor people can't keep their savings in huts. They have to carry their savings with themselves. And what best option but to buy a gold chain or a gold earring or a gold bangle? You are able to move with your savings. The third, and probably a very, very big contributor, is that gold can be bought in black market and your black money can be stored. Now, we have to tackle all the three situations. By opening Jan Dhan account, we have ensured that poor people can deposit their savings with bank. They don't have to invest in gold. Second, by increasing data analytics, we are going after people who are storing, money in gold, their black money in gold. However, we need to do a lot over there. One thing will be to bring gold in GST so that you can track buying and selling. If that happens to a great extent, black marketing of gold will come down. The third is the financial education. We have to push investors to buy sovereign gold bonds instead of buying physical gold if they want to invest for their daughters. Now, all these things will take time because we are trying to change traditions of 1,000 years plus. Today, the biggest challenge is that when you want to buy gold, you just walk into a jeweler shop and buy gold by paying cash. When you want to buy a financial instruments, you have to go through KYC and you have to follow a process. If we make buying of financial product as simple as buying of gold, if we educate investors financially about how gold import can hurt India and how there are alternatives to buy gold without actually owning physical gold, and then we push tax data analytics in a manner where there is no incentive to put your black money in gold. Put all these things together, we can actually start monetizing our more than $2 trillion worth of gold.
Yeah. Now let's come to the mutual funds. We globally there has been a big trend towards passive funds. There is a big vanguard, which started in late 80s. How do you see that vanguard story playing out here in the country? Especially given the whole debate around active versus passive.
So undoubtedly, slowly and steadily, markets will move towards passive funds. As long as active funds are generating alpha, investors will stay with them. When their alpha generation capacity will come down, investors will move towards passive funds. We will have coexistence of active fund managers as well as passive fund managers in the future. Active fund managers will start adding value to customers not only by just launching long-only funds, but also leverage funds, long-short funds, concentrated funds, and global funds. Active fund managers will also launch wrapper on passive funds, which provide solution to customers by allocating between various sectoral ETFs or various asset classes ETFs. So the nature of this business will change, whereby the objective will remain the same. How do I add value to my customers so that I can justify my fees? There will be product innovation like leverage fund, long-short fund, global funds, concentrated funds. There will be service innovation like wrapper around ETFs, and there will be pure play passive funds, which will be low-cost solution provider to investors. And this juggernaut will continue to roll in coexistence.
Okay. Now, in current times, fund managers are being judged monthly, quarterly. I mean, we all have seen that and gone through that, against the benchmark. So you think the fund managers are being forced to track index very closely? How does the leadership looks at that?
So if you try to judge Donald Bradman on his every inning, in some inning he'll be a super batsman, in some inning he'll be a disaster. Yet no one can take away that Donald Bradman was one of the greatest batsmen.
Yep.
Now, suppose if you judge Donald Bradman as a bowler, he'll be the worst cricketer in the history. He has not taken any wickets because he didn't know how to bowl. So when you are evaluating fund manager, you will have to look at his long-term track record. If you evaluate him on every week, every month, every quarter, he is not going to be as successful always. Some fund managers are value oriented, some are growth oriented, some are growth at reasonable price oriented. Now there is a cycle in the market. When you are managing 100 crores, 10,000 crores, you can move from value to growth at reasonable price. But when you are managing 100 lakh crore, you can't do that. You will stick to your philosophy, and over a cycle that will deliver return. You'll have to take underperformance as well as outperformance together. Now, if you evaluate this fund manager against a completely different indices, it's like evaluating Don Bradman as a bowler rather than batsman. And I have seen some of studies which have compared our large cap fund, which is benchmark against Nifty, versus top 100 index. Now I am trying to outperform top 50 index. Please don't judge me against top 100 index. Similarly, there are periods where Rajbhai, we take underperformance for a reason. So I can share this incidents about 2017, where we avoided investing in an IT company which moved from 1% to 4% of index in a year's time. Now, it was a conscious call. It resulted into underperformance. We were paying, but we were willing to bear that underperformance because we didn't believe in that company. With the benefit of hindsight, that company is down 90% from the top. So sometimes underperformance is because of conviction, sometimes underperformance is because of style, and sometimes you hear and see underperformance because people change benchmark. So please promote fund managers on the long-term track record, not with this prism of prejudice.
No, very well said. Now, we are in the last 10 years, and you talked about digitization as well, and we have seen a lot of innovations in the markets as well. We have seen Zerodhas of the world have come up, who have actually helped us in growing the market. And we have also seen, innovations like small cases. Now, Zerodhas, they promote a lot of do-it-yourself trading. A lot of people are trading on their own. Small case are giving a basket of stocks and all. How do you guys view them as? Do you see them as a competition? Do you see them as partners? What do you see them as?
See, they are all our partners. More the merrier in this business. When there was one unit trust of India, it expanded market to some extent. When SBI Mutual Fund, InBank Mutual Fund, CanBank Mutual Fund, Boy Mutual Fund joined in, they expanded market to some extent. When Morgan Stanley came in, it expanded market to some extent. When Templeton, Alliance, ICICI Prudential, Birla came in, they expanded market to some extent. We have seen that over the years, as number of players expanded, market kept on expanding. With all our track record, we just serve about 3 crore Indians and about 10.5 crore folios. I need to be serving 30 crore Indians today and maybe 150 crore Indians in future. Now, how will I reach there? If we depend upon existing players, the pace will be very, very slow. We need other players like Zerodha, like Small Case to expand the market. So we are all partners in expanding the market and ensuring that Indian savings move from real estate, gold, and bank deposits to equity markets, to structured products market, to hybrid market.
Yeah, true. Now, you once said in an interview, and I'm just quoting you from there, that you invest in those companies which constantly reinvent themselves, so that the disruption from new age tech companies entering the market doesn't impact them. Do you want to talk about some examples here?
So essentially, you have to cut your own successes. Now, for example, you are a great fossil fuel company, fossil fuel engine automobile company. Now, you are doing extremely good in that, but you have to reinvent yourself by launching electric vehicle or fuel cell or hybrid. You are today running a great channel which is direct to home. You'll have no option but to introduce OTT platforms for your viewers. You are, launching, let's say you are in movie exhibition business. Now, when movies are not coming and people are watching IPL, you'll have to reinvent yourself by showing IPL on a bigger screen. So in every business, people will have to reinvent themselves so that they remain relevant to customers. In financial services system, where bankers believe that theirs is a lazy business, you borrow money from investors, lend it to customers and get your spread and play golf. Well, that was true some time back, but now it's no longer true. You'll have to introduce yourself as a fintech player, as a new age digital bank, so that you can remain connected with the customer. And also you can put to use your surplus money. Now, in every segment, this change is happening. In pharma sector also, from old molecules, new molecules are coming. Unless until you research and reinvent yourself, you will not be able to compete in the market. So we are right now focused, like before, in investing in those companies who are also investing for future, who are reinventing themselves to cope with the future.
Okay. We're seeing real estate revival that has already started. I was actually amazed to see that the real estate index was the second best performing after IT in the last 3 years. Most of the performance has come in the last 1 year itself. Now, along with real estate, what are the other two allied sectors you think you would like to play this cycle?
So we generally play this via what we call home improvement sector. Mm-hmm. And over here we believe cement, plywood, tiles, paints, electrical wires and cables, consumer durables. These are all the sectors which will do as good as real estate sector. Apart from the basic real estate growth, they will also benefit from replacement demand. And more importantly, in each of this segment, there is a migration from unorganized sector to organized sector, from small and medium enterprises to large companies. So this home improvement, we believe, is a longer term theme compared to just pure real estate or construction company. And you will be able to play it across sectors, from cement to tiles to paints to wires and cables to consumer durables.
Yeah. Okay. There are a lot of young guys who listen to our podcast, and so I will just ask a couple of questions on their behalf. You mentioned about, when you started your career, everybody makes mistakes, right? And so what has been your, biggest mistake when you started your career, and how your investing philosophy has changed over the years? So let's start with that.
So the biggest mistake in the 90s was to go and buy on tips and lose entire capital.
True.
That was a big hit to me, because we were not that rich. And that greed of making more money actually ended up destroying whatever little money we had. So that was a big learning. As a professional investor, the big learning came in 2000. We had invested in the same, stocks. And one of the investors came back to me saying that, Nilesh bhai, if I want to make this error, I am capable of doing on my own. When I give you money, I expect you to make errors which I won't make myself.
Yeah. Oh.
Now, that was a very good learning. And thereafter, we have never ever gone wrong on businesses. We will invest not based on tips, not based on what companies are telling us, not based on what sell side is telling us. We will invest based on our own research. And today, Raj, by 2017 to 2021, we have seen many companies faltering apart. A big housing finance companies where a marquee investor had invested has fallen.
Yeah.
I talked about an IT company which was part of the index and we avoided. There was a beverages company in Gujarat which went fut. Out of all those disasters, by and large, we have stayed away. And that's a matter of pride. It's not that we are the best performing fund in the country, but definitely we have avoided many of the pitfalls which many peers as well as other investors have done in terms of selecting business. So the biggest learning for me is that today I'm managing trust and confidence of investors. They give me money for my professional capability, not because of the returns I have generated, because my returns are my past, my professional capability is my future. I have to invest in real businesses. I have to invest with themes where I may go wrong, but the price of going wrong will not be very severe on my investors.
Yeah, true. Before I move on to the second point, I actually want to talk about, which I missed talking about, is the fixed income. Globally, we are seeing rate cycles. A lot of central banks have actually started moving up on the rate cycle. There is always a talk on and pressure on RBI to act because inflation is coming up everywhere. In the last 1 month, actually, interest rates have gone up almost in every country. I mean, market-based interest rates have gone up, not necessarily the policy rate. How do you see, Indian fixed income moving in the next 1 year or so?
So in the fixed income market, RBI is the biggest influencer, and they have done a remarkably superb job. They absorbed liquidity, which was coming through huge amount of foreign direct and foreign portfolio investors. They contained inflation. Now inflation in India and US is the same. They ensured massive borrowing program of the government goes through smoothly. They ensure that interest rates remains under a range. They ensure that financial markets continue to function despite of COVID-19, despite of Franklin Templeton winding up of schemes and which impacted debt market in April 20, despite whatever second wave of COVID-19 came and hit us. So RBI's influence on our fixed income market will be significant. My feeling is that rates will rise from current level, but it will be a calibrated, gradual move. RBI will first lower the corridor between reverse repo and repo rate. Then they will change their stance from accommodative to neutral, and eventually they will raise repo rate. At the same time, they will intervene in the market to ensure that there is no disruption. It's gradual and calibrated movement. And as long as you are reading RBI correctly and positioning your portfolio in line with their action, you will be able to make money in fixed income market.
True. Now come to the second point regarding the young investors, and you know that there I read that there are more crypto investors in the country than actually the stock investors. What do you think about the crypto asset class? Is it an asset class? What is it? How do you see that?
So Rajbhai, my feeling is that a lot of this is misinformation. Mm-hmm. One global report said that there are 11 crore crypto investors in India. I'm willing to bet that that's a completely wrong report. In fact, it's with a malafide intention to create fear of missing out among Indians.
Possible.
There are crypto investors. I'm not denying that. Mm-hmm. But I'm denying the fact that 11 crore investors are there. That's complete bullshit. Number two, crypto investment is actually crypto trading. It's not crypto investment. There are more than 9,000 cryptocurrencies. Many of those have fallen 100% in one single day.
Yeah.
We look at Bitcoin prices and believe that all 8,999 currencies will move in tandem. That's absolutely wrong. 8,999 cryptos can fall also. Number three, today, whether we like it or not, there are powerful forces which are marketing crypto. There are many people who doesn't want their transaction in money getting watched by regulators. And if they popularize crypto, it gives them a great ability to move illicit money from one jurisdiction to another. It gives rogue nations ability to defy global sanctions. So there is a powerful force which is pushing this cryptos. Number three, if you hear about crypto, it's essentially coming from people who have made money on crypto. Obviously, they are going to talk positive about crypto. Number four, in crypto, safekeeping is very, very critical. Every day we hear how people lost their valuable crypto because keys was lost, because hard drive crashed, because exchanges disappeared. Now put all these things together. If you want to invest or trade in crypto, please do it. But please do it with an open mind that this is high risk, high return gamble. There is no fundamental way to evaluate crypto's performance. It is running on the faith that tomorrow there will be a buyer for this at a higher price. Please ensure that you commit only that part of capital on which you can take risk. Please ensure that you deal in a manner where safekeeping is guaranteed. Otherwise, your profit will remain mark to market and losses will become real. So, if I have to sum up crypto, the Bank of England official made it very nicely. Please put that money in crypto which you can afford to lose.
True. I have one more question, which I'll come later, and that will be the last part of our talk. But before that, you want to make any predictions on a market? Index or anything?
Rajbhai, we have realized very early in life that you don't have any ability to predict future.
True.
In fact, I will share my daughter's experience. When she was young, she used to see me coming on television. And she said that, Papa, I also want to come on television. So I said, Beta, you have to study and learn. Then you can come on television. He said, no, whenever you have gone on television, what do you say? In the short term, markets will be volatile. Long term, everything will be fine. You don't say anything else. So that was the, eye-opener for me. And that's the reality. We have no ability to predict future. In Jan 20, I had no idea Nifty will go to 7,500. In March 20, I had no idea that it will reach 18,000 in October 21. So let's accept our limitation. All we can say that directionally equity will go up and you will make money if you invest with good companies and good managers.
No, that's very well said. Now, this is the last question, and this is what we ask every one of our guests. One advice you will give to your 20-year-old self?
My 20-year-old self, I would have said that learn from others' experience. You don't have to repeat mistakes which others have made. You can learn from them. I wish I had gone and met that Devladhari uncle much earlier in my life. I would have lost far less money. But better late than never. Many times you learn by committing harakiri, but it's important if you learn from someone else's harakiri.
True. On that very positive note, we'll end our conversation. Thank you so much, Nilesh Bhai. It was really pleasure to have you on the show.
Thank you, Raj. It was my pleasure.